Hello and happy November, friends. Hope we've all been enjoying what has very much been our closest return to a normal lifestyle in almost a year and a half, and getting out and about and taking full advantage of some of the amazing weather that Melbourne has been sprinkling us with in between those wet and windy days as well. Well, as this year starts to draw to a close, because Christmas is ultimately around the corner, we're going to look at some of the key economical mechanics that are happening behind the scenes at present and what likely impacts these will have on our local property markets now and beyond as we get set for what's going to be in store for 2022. So some of the key points making headlines in recent weeks. With the latest inflation figures pointing to an inflation rate sitting at about 2.9%, the RBA, that's the Reserve Bank of Australia, has indicated the 3% mark will be the trigger for them to start to raise interest rates. We could see this take effect as early as February 2022 in attempt to curb rising inflation levels. For some other important news, as of the 1st of November, APRA has brought in a new higher assessment rate requirement of an additional 0.5%, which has effectively lowered borrowers' buying capacity by about 5%. We're going to pop up a graph on screen now, which gives you an approximate indicator of how this will affect your borrowing capacity at different levels. There's also a pending election campaign coming next year, which will create some uncertainty around some of the new renewed proposed changes to the property tax laws. This will either see investors flock to the market prior in a bid to secure a property and shelter under tax benefits, which will be grandfathered for purchasers prior to the cut-off date of any changes. Or this will also likely see investors sideline and wait to see what impact this will affect and have on property prices. With regional areas now reopened and accessible to most Melburnians and Victorians, and interstate travel slowly returning state by state as the borders open, as double vaccination targets are reached around the country. The expectation and predictions are that regional markets will actually start to cool a lot quicker as these restrictions ease and the push and the desire to move away from capital cities dissipates and people return to the CBD for more traditional work and lifestyle opportunities. Interestingly, homes are selling the fastest in Sydney and Hobart, whilst Melbourne is one of the slowest moving capital city markets around the country. Figures released by the Domain Group have also shown in Melbourne the number of property listings that are available has jumped a staggering 118.5%. That's right, 118.5% in Melbourne over the past month, which is something we are already starting to feel on the ground, with overall buyer attendances and numbers getting spread thinner and price growth stabilising ahead of what will likely be a year of levelling prices in Melbourne for 2022. All in all, it seems that now Melburnians actually have some normal things to be able to do and enjoy in life, and are not solely stuck in their homes with nothing much else to do besides online shopping for goods or buy a new home. The signs and signals are pretty clear that this temporary and somewhat artificially fueled run in the property market may soon draw to a close, with property and the economy set to return to a more trend growth pattern. So that covers our November market wrap. From myself, Claudia Cuomo, and the entire C+ and residential team, we wish you a most enjoyable November. Get out there, enjoy life, catch up with those long-awaited family and friends, and if you're in the need to upsize, downsize or secure your next investment property, well, you know who to call. No, not the Ghostbusters, C+ and residential, of course. Bye for now and take care.